Hey guys, what's going on? Welcome back to the channel. So this video is going to conclude the Vanguard series, and I'm going to be turning my attention to the ETFs that are available within Vanguard. The last video we had a look at the index fund specifically. So this one is going to be looking at the ETFs. Now there are 13 equity ETFs that I'm going to be focusing on. I'm going to be walking you through every single one of them, talking about performance, where they're invested, some key stuff that is important for you to know. The fixed income or the bond ETFs, I'm not going to really go into detail on. I will just kind of reference them, maybe drop you some nuggets, some nuances that are worthwhile bearing in mind if you are considering using them. So this video might be a little bit longer than what you're expecting or have come to expect from the channel. But with that said, if you're a first-time investor trying to select an ETF, this may help you greatly. So with that being said, there's a lot to cover. Let's kick off. Okay, so disclaimer, obviously, guys, please don't take this as advice. I don't know your time horizon for investing. I don't know your goals. I don't know your risk appetite. So use this as a means to do your own research and for educational purposes only. That's what it's intended to do. It's intended to hopefully help educate you on your selection, your choices. What we're going to do is we're going to go over to the Vanguard website. I'm going to show you where to find it. It's pretty straightforward. It's right over here. Go on their homepage. What do we offer? We need to go onto the ETF. Now, like I've already alluded, there are 13 equity ETFs specifically. We're going to be talking about those. There are an additional 8 ETFs that are essentially bonds or fixed income. We're not going to be covering those in this video. So I'm just going to collapse that, expand the equity. So let's get straight in and talk about the European ETFs first and foremost. So we've got a FTSE developed Europe, excluding the UK in this instance. Before we jump into this, actually, just bear in mind, this is the cost of all of these ETFs right here. So for the European ones, the cost, the ongoing charge for these are exactly the same, 0.1%. So really, really cost effective. They are all 100% equity. So again, if you are a first-time investor, it's really important for you to understand where you sit on the risk scale, because if you are a cautious investor, this may be a little bit too much for you in terms of the volatility that it's going to deliver, because it is invested 100% in equities. If you don't know what your risk profile is, then consider actually booking me for some one-on-one work. This is the kind of stuff that I go through with people. I identify what your risk profile is. And we also get to talk through, what each of these actually mean if you need additional help. But there will be a link in the description below where you can actually book me for one-on-one work if you choose to do so. The other thing that's worthwhile bearing in mind here is, the risk numbers. So again, this is a 6. Vanguard score out of 7. So if you are cautious, you're probably going to be something like a 3. This is doubling the level of risk that you would potentially take. So a key consideration for you to bear in mind. Again, this isn't financial advice. If you do decide to go up to this ETF and this level of risk, you need to understand it's going to be very, very volatile. So it's going to go up and it's going to go down quite a bit, and you need to be prepared for that. So the FTSE developed Europe, excluding the UK. This particular fund is the VERX. It's invested in 466 stocks altogether. Again, this is the ongoing charge. This is the risk factor out of 7. Now, this is an ISA-ready investment. So with tax year about to end, if you're looking to utilize your ISA allowance or you're looking to utilize your ISA in the new year, you can actually purchase this ETF in the form of an ISA, which is fantastic. This one excludes the UK. Now, this was founded back in incepted in 2014, so not around the financial crisis, way before then. And this is the last 5 years' performance. So with this, when you tally this up, this gives you a performance of 42.5% over the last 5 years, which averages out about 8.5% roughly per year. Let me just make sure that that's right. 8.5% each year, so pretty good performance. But again, when we're looking at these kind of things on Vanguard, it's really important that you're going to have a look at the portfolio data, okay? Just so that you can see where the exposure is. Where are you invested from a geographical point of view? We know it's in Europe, but where in Europe? So you've got France, Switzerland, and Germany being the top 3 countries that you're invested in here. You can also pay attention to this section, which will talk you through the industries where you're holding most of your money. So industrials is a big thing here in this particular fund, 17.4% industrials. Then you've got healthcare at 16%, financials, which will be banks, insurance companies, those kind of companies, 15%. Interestingly, tech 8.7, because we don't really have a big tech holding here or companies here on the continent of Europe. So always worthwhile paying attention to those kind of things as well. So this is the first one, and as always, you can see the list of all the companies that you were invested in right there. So if you wanted to do certain due diligence on, Nestle or Roche Holdings, you can also do that as well. You've got LVHM as well, which is a really, really good luxury brand that you're also going to hold some, and those are in your top 10 holdings. So pretty good. So that's the VERX ETF. Let's go out back onto this and let's have a look at the second one. The second one is a FTSE Developed Europe. Now, this will actually include the UK. This is the VEUR. This one is invested in 592 stocks altogether. Again, still a 6. Cost is identically the same. This was incepted back in 2013, and it is, again, ISA ready. Now, with the performance on this one, this has performed at 34.85% over the last 5 years, which gives you a return of about 6.97% annually over the last 5 years if you look at the average figure. Now, because this includes the UK, you're going to see some UK exposure when you go and look at the portfolio data. And actually, lo and behold, UK is the highest weighting within this particular fund. So if you do have like a homeland bias where you do want to be exposed to some of the UK markets where, frankly, we've got some really good recovery stocks, IAG, for example, then this may be something that you want to consider and actually have in your portfolio. So yeah, UK, France, Switzerland, Germany. Those are your top 4. But there is a big heavy weighting towards the UK taking preference in this particular fund. This is where they're invested, a slightly different mix-up within this one here. I think on the last one, these ones were swapped over. Healthcare was second, financials was either third or something like that. So we can see how it's changed shape in terms of sector exposure as well. And again, you can see all of the top 10 holdings, or those that they look identically the same. So that is the VEUR. Slightly behind when it comes to performance versus the first ETF that we looked at that excluded the UK, but pretty good performance nonetheless. So if you're going to pick between one of the two, do you go the highest performance one? Possibly, but again, just bear in mind that past performance is no indication to future performance. So you'll need to have a bit of a decision and a conversation with yourself on that point right there. The next one we're going to have a look at is the German All Cap. Now, obviously, with it being German All Cap, it's solely invested in Germany. You have no other exposure to any other areas in Europe apart from Germany. So why might you pick this? You might pick this if you have a particular interest in Germany or particular companies within Germany. But this one is invested in 151 stocks. Again, it's a 6, it's ISA ready. And the performance on this was incepted in 2018. So this has only been going for about 2 years or so. And as you can see there, the performance is 19.76%, which gives you an average of 9.88%. So over the last 2 years, actually the performance on average isn't that bad, but you don't have a 5-year track record to be able to look back on to see how they would have performed back in 2018 when most funds suffered because of the blip back then. So again, worthwhile bearing in mind. Let's have a look at the portfolio data, and I will be paying particular attention to this if you were investing solely in Germany. What companies do they have in there? These are the sectors: industrial, technology, financials, healthcare. Consumer discretionaries are the top though. I'll be looking at these. So what are the companies? So Daimler's in there. You've got Allianz in there, Siemens. You've got Deutsche in there as well. So some big companies. Would you want sole exposure to Germany though? That may be a little bit too much concentration risk in one country for me personally, but you may see this very, very differently. So that is the VGER, which is the German all-cap ETF. Let's move to the global view. So this is the FTSE All-World High Dividend Yield. Now, let's talk a little bit about this, because high dividend yield essentially means that this is being invested with the purpose of generating dividends for you specifically. So this is invested in 1,507 stocks. The cost of this is slightly higher. It's 0.29%. And out of 7, this is rated a 5. Specifically, it's ISA ready, incepted in 2017. Now, with all of these ETFs, you'll find that they are passive management, which means that they're essentially going to mimic the performance of the index that they are designed to essentially track or copy or mimic, in other words. But this one is going to be invested with the target of paying dividends. And you can see this right here. The index is comprised of large and mid-sized company stocks, excluding real estate trusts, in developed and emerging markets that pay dividends that are generally higher than average. So it's built to pay a dividend. So if you're looking for a dividend paying investment, this could be really, really useful for you. In terms of performance, actually, not really too bad. The performance on this has been 47.19% over the last 5 years, gives you an average of 9.43%. Let's go and have a look at the portfolio data again, because it's important. All world, obviously America, Europe, Pacific, emerging markets you've got exposure to here. United States, heavily weighted, 39.9%, but followed by Japan, UK, Switzerland, Taiwan, Germany, Australia, Canada. Again, they are looking at dividend paying companies specifically. And you will see that across the sectors, and when you go into the company list, you're going to see that pretty much all of these companies, the selection criteria means that all of these guys will pay dividends. So again, if you're looking for dividends, could be really, really good for you. So that is the VHYL, and that is the FTSE All-World High Dividend Yield ETF. The next one we're going to have a look at is going to be the FTSE All-World altogether. So with the FTSE All-World, this is not specifically aimed at dividend payments. This will be looking at, investing in all of the world. It's going to give you global exposure and pretty much looking for growth more than anything else. This is going to be invested in 3,514, so quite a large number of companies globally. The cost ratio is different to the last one. It's 0.22 as opposed to 0.29. Again, it's a 5, ISA ready, incepted back in 2012. Now, the performance on this, actually, when I had a look at this has performed extremely well. This has performed at 73.86% over the last 5 years, which gives you an average of 14.77%. Now, again, this is going to give you global exposure. So when you go here, you're going to see North America, Europe, Pacific, but let's have a look at the countries. So, the UK is in here, but it's down to 4th in this example. Interestingly, they've got China in here as well, and they've got Japan as 2nd and 3rd positions. But this is, over 50% in the United States. So a heavy weight into America being the largest market currently. And again, across the sectors, you will see that you've got a good distribution, but obviously heavy weighting in tech, because most of the tech giants essentially live in the United States. So you've got that there. You can also see the top 10 holdings here. So these are the companies you would expect: Apple, Microsoft, Amazon, Facebook, Tesla, Google. You've got Taiwan Semiconductors in there as well. Alibaba forms part of the top 10. So that right there is the VWRL, which is the FTSE All-World ETF. The next one we're going to go and have a look at is the FTSE Developed World ETF. And this one, let me just collapse this bond one. I don't know why it keeps throwing that back out for me. Is this one right here. This is the VEVE. And this one is better cost than the rest of them. This is only 0.12%. Again, it's still a 5, but it's invested in 2,162 stocks altogether, incepted back in 2014. It is ISA ready. The performance on this is 73.84%, which is on average over the last 5 years, 14.76%. So it's actually not too far behind the all world. But with this is literally focusing on developed markets. So when we go into the portfolio data, you're going to see in here, well, they don't hold China in here because China's classed as an emergent. So you got US, Japan, UK. Again, quite a lot in the US though, 63.3% in US. And that would tell me that tech is going to be top of the pile again with this as well. So you're going to get global exposure, quite a bit of global exposure in developed markets. And you can also see all of the top 10 here again, the names that you come to expect from a developed world fund. So really, really good. So that is the VEVE. Now we're going to go and have a look at, there are two UK ETFs available with Vanguard at this point in time. They are the FTSE 100 and the FTSE 250. Now, bearing in mind, I'll be interested to see the performance of this. And I do have it here, guys, but no surprise that these haven't really performed that well, particularly because of some of the challenges that we have faced, certainly last year with COVID and obviously with Brexit. So the FTSE 100 ETF, which is the VUKE, has 102 stocks in it. Actually very, very good in terms of cost price point. So 0.09%. This is still a 6 though. So this is invested in the FTSE 100 specifically. So it's going to mimic the performance of the FTSE 100. But when you look at the performance, look at that. I mean, the performance right here over those 5 years is 27.8%, which gives you an average of 5.56%. Struggled there. It was a negative in 2018 where most of the funds were, but look at that last year, not that great. I think there's still a lot of value in the UK because, you know, we've got some great recovery stocks here, but when you're trying to build a portfolio of maybe comprising them of ETFs, do you include the UK? Some will say that there is good value here, so to include it, but at what proportion you include it is going to be the big question, right? How much of this do you allocate, of your capital do you allocate into this if you do put UK into it? This is the FTSE 100 though. I think it's worthwhile going to have a look at the FTSE 250. Now the FTSE 100 are obviously the large cap companies here in the UK. The FTSE 250 kind of encompasses some of the mid cap as well. So let's have a look at the FTSE 250. The FTSE 250 has done better. It's invested in 251 stocks. It's slightly more at 0.1%. It's still a risk 7 though. But with this, look at the performance is better. So the performance over this 5 years for the FTSE 250 is 80, that would be lovely. 37.31%, which on average over the last 5 years is 7.46%. So performed better by just under 2% than the FTSE 100. Now, which one of these you select is really down to you. Yes, with the FTSE 100, they're the top 100 companies in the country. The FTSE 250 gives you a wider base into some of the mid-cap ones as well, though. So in selection terms, I think if you look at the portfolio data here, it's the kind of companies that you're going to have in here. And what I would say is strongly compare what you've got in this company list versus the one that you have in the FTSE 100 list, because there's going to be more companies available, and there might be names that you kind of recognize in the FTSE 250 that you might take an interest in. So do the comparison. Yes, cost is a thing, performance is a thing, although again, past performance is no indication of future performance, but it is still a thing that is worthwhile considering. So that is the FTSE 250. That is the VMID ETF. Now let's have a look at the US ETFs, which are essentially down here. So we've got two. We've got the FTSE North America ETF. So this is invested in 635 stocks, price point 0.1%. ISA ready, incepted back in 2014. So the performance on this is 85.55%, which gives you a yearly average of 17.11%. Now, interestingly enough, this isn't just invested in the S&P 500. So S&P 500 is obviously a big market. Everybody knows that as an index. This is invested in more companies. Again, it's purely in, North America. So you've got a little bit of Canada there, but mostly in the United States. Tech obviously being a big weighting because of the region and the fact that you've got so many tech giants. These are the top 10. So when you look at this in comparison to the next one, so that's the VNRT, and the next one is going to be the VUSA, which is essentially the S&P 500. It's interesting to see the difference between the performance of them both, because here it is. This is the most popular one. Everybody talks about the S&P 500, right? This is invested in 507 stocks at 0.07%. So in terms of cost, lower than the North America VNRT ETF. But this is going to be invested in the top 500 companies really in America. The performance on this is 84.14%. So on average, over the last 5 years, that's a yearly return of 16.83%, which means that the North America ETF has actually outperformed the S&P. Now, there could be a number of reasons for that. It could be the number of companies that it's invested in, broader diversification, a broader company base that they're invested in. But it's a really, really good comparison. If you look at the portfolio data here, many people will be very, very familiar with this. This is 100% in the United States. You don't have any Canadian exposure. Again, tech is top. And within the top 10, you're going to know all of those names because they are big global names. So, if you're looking at the USA ETF, which one of those do you actually go for? Really, really interesting decision to make because one's invested in 635, one's invested in 507. Does the additional number of companies give you additional growth potential? Potentially. But which one do you pick? I mean, S&P 500 historically has performed extremely well. So again, past performance is no indication of future performance. Do you go there? Do you go with North America? That's not for me to advise. That's not for me to say, but it's something that is worthwhile considering and bearing in mind if you're doing your analysis. And I would be comparing against, yes, historical performance, cost. There isn't really much in it in terms of cost, but an interesting debate to have in terms of which one you include. You could obviously have both and split your money across them as well. So let's go and have a look at the last three markets. We've got three more to cover. So the first one that we're going to cover, it keeps opening up the fixed income, and I don't want that tab. The next one that we're going to have a look at, let's have a look at Japan. So the FTSE Japan. So again, this is only going to be invested in Japan, pretty much. So the VJPN, 513 stocks. It's going to cost about 0.15% per year. This is a risk 6. It's ICE already incepted back in 2013. When you look at the performance of the Japan ETF, this has performed at 60.69%, an average of 13.13 over the last 5 years. And as you can see there, 2018 was not good. 2019 was okay, but you can see quite a bit of volatility there. It's quite a way to go from 22% that year to minus 10% that year. This is where it really shows that you need to have the stomach for investing, really. But yeah, I mean, performance on average over the last 5 years, you're still in the double digits. So let's just have a look at the portfolio data. Again, it's Pacific Japan. It's fully invested there, so you've got concentration risk. That's worthwhile bearing in mind. And as you could probably imagine, industrials are top of the tree when it comes to how they're invested sector-wise, and companies on here. I would say if you're going to look at this one specifically, maybe do go and have a look at some of the companies aside from Toyota and Sony and some of Nintendo that you might actually know. It might be worthwhile just for your peace of mind, just doing a bit of research on, say, NIDEC, for example, just so that you kind of know what kind of companies they're looking at. Maybe pick a handful, do some further research on there. But that is the Japanese ETF specifically. The next one we're going to have a look at is going to be the Emerging Markets ETF, which is going to be this one right here. So it's the FTSE Emerging Markets ETF. And the price point for this one is 0.22%. This is a risk 6. This is invested in 1,815 stocks incepted back in 2012. Now, this one, performance-wise, has done 79.57%, an average of 15.91 a year over the last 5 years. So again, double digits, really, really good. But again, just like Japan, you've seen it go from 27 to -9. And then, brief recovery or trying to recover back in 2019. Actually, 20 is done very, very well indeed. So again, this is the benefits of global diversification, right? You're going to have territories like this that do really, really well, maybe developed worlds that don't do as well in those kind of spans. And this is where you try to stack the odds in your favor. You try to ensure that you've got access to different territories so that regardless of what's going on in the global picture, you're going to have territories that thrive at certain points in time, and you get to ride the wave of each of those occurrences happening as and when they happen. So really, really important to bear in mind. That's the reason why diversification is so, so key. Now, portfolio data, emerging markets, essentially you got China, Taiwan, India, Brazil, South Africa, Saudi Arabia, Russia, Thailand. This is a good bit of exposure to the emerging markets specifically. Again, tech, they're heavy on tech actually, 26.9% in techs, 19.3% in financials. And you can have a look at these companies in here as well. So Tencent, Alibaba, yeah, you've got Taiwan Semiconductors in there, really, really big company, JD.com. And Neo is actually in here as well, interestingly. So you can go and research these companies, go and have a look at them as well. And the last one we're going to have a look at is going to be Asia Pacific. So let me just collapse this fixed income, drop down again. This is the last one. This is Asia Pacific. This is the VAPX. This is 395 stocks, cost point of 0.15, risk factor of 6 out of 7, incepted back in 2013. The performance of this one over the last 5 years has been 76%, well, 76.13%, average of 15.22%. If you've noticed, all of the emerging market ones, or emerging markets, Asia Pacific, Japan, they have all returned in the double digits. And the same with, the USA. They've all returned in the double digits, really. So impressive performance. But again, look at that. I mean, 2020. 35.99%. And as you can see again, the volatility in that region, right? 20% down to -5%. Not as drastic as what we saw with Japan, but you can see that different territories react differently. And there seems to be this kind of theme when it comes to looking at emerging markets, Asia Pacific and Japan in that regard specifically. So again, really, really good performance on this, not an indication of future performance. Let's go and have a look at the portfolio data. So Australia, Korea, Hong Kong, Singapore, New Zealand is where this is primarily invested. There's quite a bit in Australia, actually, 39.4%, heavily in financials in this instance, though. So 25.3% tech, it's 19.7%. And again, you can go and research these companies. So Westpac, for example, I've heard of before, National Australia Bank, I've heard of before as well. CSO I've not heard of. So again, you can go and research these companies. Samsung, you would actually know. So that's an overview of all of the ETFs that you have available in Vanguard. Well, the equity ETFs in Vanguard. And I wanted to give you kind of like a brief overview just so that you know how they performed and what you can kind of expect if you're looking to invest with them based on past performance. And again, it's no indication to future performance. But if you're trying to research these funds and think, right, how do I actually incorporate these into my investment strategy, then I think some key things to consider are the following. First and foremost, you need to understand what your risk factor is. Most of these equity funds are either a 5 or a 6. Notice you don't have 4s or 3s in there. So your risk factor is very, very important. You don't want to go and get into an ETF that is going to be more volatile than you expect it to be. And the volatility is simply just explained as how much it's going to go up and go down on a monthly or weekly or even on a daily basis. And with high volatility, yes, the potential for higher rewards is there, but the potential to actually lose money is also there as well. So you kind of want to get the balance. That's the whole point of investing, right? Stacking the odds in your favor. So your risk profile is really, really important for you to understand. Where are you on the spectrum? Are you a 3? Are you a 7 out of 10? Where are you? Because with that being your starting point, you kind of get an idea of where your natural mindset is going to be when you start thinking about risk specifically. Now, depending on how long you're looking to invest for, you can afford to go up the scale to maybe a 6 if you're investing for the long term. But if you're investing for the short term with maybe a house purchase in the works, maybe in 2 or 3 years' time, then something like this could be a little too much for you. But again, that is your decision to make. It's not for me to advise you on that. The next thing you need to consider is diversification. So obviously we've looked at these ETFs across different areas of the world. Europe, you've got global exposure in there, you've got UK, you've got Asia, Japan, you've got emerging markets, developed markets. Those are the ones we've looked at today. The key thing for you to remember is, much like we've seen with the Japan, Asia, Pacific, and the emerging markets ETF, is that if you look at them in comparison to the global or maybe the US or the UK performance, 2020 numbers are drastically different, like drastically different. And again, that's the whole point of diversification, giving you the ability to have access to different regions where, you know what, they might perform better in this at this period of time, where the rest of the world or the UK, for example, doesn't perform too well. And it means that because you spread your money across those different areas, you get the benefit of that performance as well. So it helps you, again, manage your risk, be able to track towards your goal if you've set one. If you've not set an investment goal, you really need to set one. Now, diversification is important. And look, as I've already alluded to, most of those funds there are 100% equity funds. I haven't touched on the bonds because of time, and I'm already quite aware that we're already really over what we would typically do on this channel for a video. But on the fixed income side, you do also have European, global, UK, US, and emerging market bonds. Now, these are 100% bonds. Bonds are a great diversifier. And what we're seeing here is that if you have a look at the European bonds, for example, they are risk rated a 3. The UK ones are risk rated a 4. Then you've got US, which is 3 and 4. You know, these are not, they're not heading into the 5s, okay? So if you're looking to diversify your portfolio, and let's just say you're a medium risk investor where you should be, you know, a 5 out of 10, you picking maybe one of these bond ETFs to help you kind of offset your risk will bring you down from, for example, going into a European one at 6, it will help you offset that risk a little bit more. So again, when you're looking at the fixed income ETFs, look at the same data, look at the performance, look at where, you know, where this money is being held, what countries it's invested in terms of geographical regions, and see what the portfolio makeup is. But guys, I hope that has been useful. I know it's been a very long video, but if you're a first-time investor, it might just be worthwhile you paying attention to this. Hopefully it's been helpful. But guys, let me know in the comment box. I appreciate you. If you've not listened to the podcast this week, definitely go and listen to it right there. It's a really good episode this Monday. But guys, as always, I appreciate you watching. Have an amazing weekend. And remember, money is a tool, life is for living. I will catch you next week.